Good morning, everybody. Good morning, team. How are we doing? It's Tuesday morning. It's 8:30. We are live to look at the latest set of housing data, this time from the Halifax. First of all, hope everybody's had a great long weekend. It's probably a slight long Easter weekend hangover. The weather has been fantastic, so I hope you've had a great time. Now, let's crack on without further ado, because we've got a little bit of data to get through. And I don't want this to go on too long as the last few have. What I also need to do is change the scrolling ticker on the start of the live stream page, which I keep forgetting to do. Anyway, so last week we had the Halifax HPI house price index data released. And I think it probably surprised a few people to show that Halifax are saying prices have ticked up again over the last month. Now, before I dive into the actual data itself, as everybody comes on to the live, please say hello. Please introduce yourself. If you're coming from YouTube, hi. If you are coming from the Assets for Freedom Mastermind Facebook group, if you want to interact, there is a little link you need to press on the live post, which will enable Facebook to post your name as you put your questions in, which would be fantastic. So say hi, please make sure you can see the screen and hear the audio. And as I go through, put any questions you have and we'll go through Q&A about anything you want to at the end. Remember, I do these sessions to go through market data, to analyze market data and dive deeper than perhaps mainstream media does. But at the end, Q&A, anything you want to talk about property in general, up to you. So that's the intro. Before we actually go into that data again, I want to talk about what I think is becoming the most controversial subject in property at the moment, and that's the house prices. Are they coming up or down? Now, look, I've been in property for a long time, about 15 years. I've been in the training space for about 10 years. And I know that one of the things that is sort of most divisive in property is property training, but it appears like we're having something that might be beating it, and that is the discussions on property prices. Are they going up? Are they coming down? There's lots of, I would say, quite aggressive conversations going on in multiple places, but especially Facebook, with people having arguments about property prices, whether they're going up or down. Again, I want to give you my view on this, and that is I'm just going to be totally objective and look at the data. I'm not particularly fussed if they're going up or going down because we've got strategies that work either way. The reason we I look at the data, look at the analysis, is to try and look at leading indicators to see if we have a better idea about what decisions we make in terms of strategy as property investors, property developers, both short-term and long-term. Because if you are, for example, a developer or a flipper, and properties are coming down in the short term, that's important to understand when you look at your deal analysis. And if you're going to be, submitting offers, are you going to put in a margin for, drops, 5% drops, 10% drops? Conversely, if you're doing return on capital calculations on your deal analyzers, you want to have an idea about where those prices are going to go. If you're looking to refinance, for example, will the prices be down in 6-12 months, or will they be up in 6-12 months, right? This is why I look at this data to help people make more informed choices, because we see a lot of headlines in the mainstream media about actually both sides of the equation at the moment. I see headlines with property prices actually stable, going up again. Other people going, we're in the middle of a crash, doomsday scenario. But they're looking at individual pieces of statistics, right? And I think coming up with conclusions that aren't helpful based on looking at one piece of stats or that one statistic. So we need to have a look at the full picture. And something with stats is there's no black and white. People just go, house prices going up, house price going down. No, there's hundreds of factors that go into this. And it's a very complex, moving set of parts with lots of unexpected consequences or things that are going to impact on other things down the line. So all we can do is have a best guess. Ultimately, we are at the mercy of external factors. But my personal view is we are still in a downtrend. I know we've had Halifax showing prices going up. And of course, the property bulls are like, see, told you, it's all rubbish. Look, this is just like 2005, a little dip before it really took off for the next 2 years. Excuse me. So there's lots of people taking this one data set and going, look, business as usual, house price going up. I personally don't believe that. We have a lot of conflicting statistics at the moment. And I think conflicting stats, we've got Nationwide saying house prices down. We've got Halifax saying house prices up. We've got ONS now showing decline, but that's in a big lag. We've got Rightmove saying listings are up. So we've got a lot of competing things at the moment. That causes confusion, that causes procrastination, okay, and inevitably that in itself, just the fact it's a confusing picture, puts some doubts in people's minds, which can then become self-fulfilling prophecies, if that makes sense. And again, as you come on, I can see people are coming on. Say good morning. I hope it's a lovely morning wherever you are. What I would say, team, right, when we're having these discussions is I want to be objective about this. I think everybody should be objective about this. I know it's really easy for people to have internalizations about what they believe is happening, or we could create cognitive biases, which is basically like we create a narrative to fit a picture that we want to be true. And look, I come from the property training industry, personal development world, where people are naturally very positive in their bias. They want everything to continue going up. And, you know, because whatever, we read these books that talk about manifestations and all that sort of stuff. We cannot believe or let any negativity or toxicity go into our lives because that's going to self-create into something moving a market or whatever. But that does create a danger. That creates an internal bias and an internalization of that decision-making process. All I'd say is keep an open mind. I could say the same, by the way, about me saying, at the beginning of this, I still think I'm in a downtrend. It's like, wait a minute, Rob, is that not a cognitive bias? Because Halifax are saying there's an uptrend. It's not as simple as that. There's going to be regional variations, types of house variations, strategy variations, right? You need to understand how it works for you. So without further ado, let us crack on into the actual house price index. Excuse me, I've got a little bit of tickle in my throat. So let's just look at the data first, okay? So the important thing here is that Halifax have said that the monthly change, and this is for March, is up by 0.8%, which is actually quite a big monthly increase. Interestingly, we are a negative change for the quarter still of 0.4% and an annual change, that's year-on-year change of 1.6%. So the big thing is Halifax are saying monthly change of 0.8%. And if we look at this graph, that's actually Jan, February and March price increases, okay? So without a doubt, you look at that and you say, that's a reversal in the trend. Potentially, I don't think it is, but you could say that's a reversal in the trend. Okay, so that's what Halifax are saying. I would like to compare that to what Nationwide, not what Nationwide have been saying, which is very different. Okay, and Nationwide say 7 consecutive monthly drops in March. So Nationwide have a monthly drop of 0.8%. Okay, and an annual drop of minus 0.1%. Okay, so Halifax plus 0.8%, Nationwide minus 0.8% is a massive skew, right? That's a big difference between the two. So one of the big questions that I hear a lot of people talking about right now on social media, and a lot of questions I'm getting asked are, why is there such a difference between the two? Why have they decoupled? And it does appear that right now the two indices have decoupled. So I want to dive into a little bit of analysis and give a hypothesis, and it is just a hypothesis, to try and explain why this has happened, because I think it's always interesting to see why there are statistical differences. to March. So you can see that's a large difference. The question is why. Excuse me. Now, to understand why, we want to go and have a look at how these house price indices are calculated. Okay. So let's go over to the iPad and let's go over to the government website, which talks about how they work out house price indices, okay, or how the different house price indices work. So first of all, if you ever want to, if you're having insomnia and you want to go to sleep, just have a good read of this. Maybe you want to watch these videos as well, by the way. That's cool, don't worry about that. Working out the house price index, right, is not just simple as looking at all the prices of the sold properties and dividing it by the number. Okay, that's not how it works. They use a model called the hedonic regression model, which I'm not even going to try and explain because, to be honest, I'm not a statistician. I did maths at A-level and engineering at university, but I'm not a statistician. Go and have a read if you want to have a read. The first thing I want to draw to your attention, right, is if you look at the number of transactions in the country as a whole, both Nationwide and Halifax are tiny, right? So these are the smallest indices by a country mile out of the main ones. The real one we care about is the UK HPI. Okay, this is basically the ONS data, UK House Price Index, which is calculated by working out the or it uses the house sale. House sales registered at Land Registry. So it's actual house sales registered at Land Reg. The problem with this is it lags 6 to 9 months. It's a massive lagging indicator. Nationwide and Halifax, okay, are based on mortgage approvals, post-valuation but pre-completion. Okay, so this could be mortgage approvals that subsequently don't complete. And as you can see as a percentage, they're tiny. Now, I saw somebody have an argument recently that actually the Halifax, which is part of the whole Lloyds, Halifax Bank of Scotland, Lloyds Group, bigger group of banks, is a much bigger index and has a much bigger market share than the Nationwide, and so the Halifax is the one that should be relied on. If you look at this, I kind of disagree with this. It is bigger, but it's still, I would say, vaguely statistically insignificant when you compare it to UK HPI. You know, there is a difference, but not a huge difference. Rightmove is based on listing price on Rightmove. So I think in uncertain times, and there's lots of flexibility, slightly irrelevant. Anyway, the thing I want to go to, okay, is the variables that go into creating these indices. And I want to look at Nationwide and Halifax because, as I said, right now we've seen a big divergence over the last however many, last 3 months. There's two things. Well, there's one thing on here that jumps out at me. There's another thing that's not listed on here. So the first thing is that Halifax includes buy-to-let mortgages, whereas Nationwide does not. Okay, I think that's interesting. But the big thing here is floor area. Okay, see, Halifax talks about floor area. Nationwide does not use floor area in their model. Now, I think this is very relevant. Okay, this is very relevant. So let's go through the buy-to-let argument first. Does buy-to-let mortgages, is it going to move the needle that much? Well, if Halifax is going up and Halifax includes buy-to-let mortgages, and there could be an argument in there that buy-to-let landlords are actually coming in and buying properties more frequently at a higher price, and that is moving the needle. I suspect that is not the case because I don't think, number one, I don't think a lot of buy-to-let landlords are piling in and paying over the odds in the current market. It's possible, but I don't think that's true. And also, if you look at the percentage of buy-to-let mortgages, I think it's about 10% of all mortgages. I'm not sure it's going to move the needle that much. If it is moving the needle and it's buy-to-let, it means the proportion of buy-to-let must be massively high, right, to bring the whole index up by that much. What I think is more pertinent is this floor area. Now, a stat that I saw recently on Christopher Watkins' analysis was, I noticed it, I didn't actually talk about it last week, was there was a small uptick in price per square foot. And I can't remember if it was listing or sale price, but small uptick in price per square foot. Now, property professionals, we care about price per square foot. If I'm doing a development appraisal, if I'm looking to do a new build or commercial conversion, price per square foot is very important to me because it means I can calculate what I'm buying something for per square foot, what it's going to cost me per square foot to renovate it or convert it, and then when I sell it, what I'm going to sell it for price per square foot. And as long as we've got a margin there, right, we've got a deal that potentially works. Most home buyers don't care about price per square foot. Okay, so if you imagine that you've got two two-bed flats, okay, one is 700 square foot and the other is 800 square foot, most retail home buyers are not going to go, I'm going to adjust the price of that because it's 700 square foot versus 800 square foot. They're just going to go 2-bed flats, right? Roughly the same price. So the 700 square foot flat is actually a higher price per square foot, right, than the 800 square foot one, even though they're selling for the same price. So therefore, smaller, denser units will often have a higher price per square foot than larger units of the same sort of number of bedrooms. So following this logic to try and understand what is happening, okay, why we've got this divergence. Here's a theory. I was trying to follow it through, and in my mind, right, if the price per square foot can move the needle, which I don't know if it does, but if Floro moves the needle, then if smaller, higher density units, right, are selling more, then that could increase the price per square foot of sale prices and therefore give an uptick on the Halifax index. It's a theory. I don't know if it's true, but with that sort of model in mind, that are smaller units selling more, I started looking into more data, right? And this is what I found, and I think this is super interesting. Okay, so this, oh dear, blimey, let me just come off drawing. Don't need that. Right, this is from Zoopla, and this is March 23 from Zoopla. Cheapest homes are driving sales. Okay, so this is annual change in share of properties sold, March 23. And look at that. Okay, dark blue lines here are bottom third of the market. Black line is middle third, and light blue is the top third. So there is a massive, that is massive skew to people buying cheaper properties. And if people are buying cheaper properties, okay, following it through logically, the chances are the price per square foot of these properties is going to be higher than if they're buying bigger, larger floor plan properties. Now, I think that is undeniable as a stat. Why are people buying cheaper properties? Well, let's work that through. Before I do, oh no, sorry, let's go back to Keynote. From about doing these things live, right? If we go to, in fact, I want to come off this. I want to go back to a Rightmove report. Sorry for jumping around a bit. If we look at the last Rightmove report, I'm going to see if I can zoom in on that. I don't know if you can see it. It says lagging sales agreed in the larger home sectors are likely to be caused by a combination of factors, including fewer pandemic-driven moves to bigger homes, a more cautious approach to trading up due to cost of living, and even perhaps concern over the running costs of larger homes. So the last Rightmove report, even though it said there was an average uptick of £3,000 per property in terms of listing price, if you dive into the detail, it talks about, right, the top end of the market is really lagging in terms of sales. So we've got Rightmove saying that. We've got Zoopla showing this. And for me, oh, sorry, I haven't actually gone on to it. Let me just go on to that. So I don't know if you've even seen that. My apologies. We've got Zoopla saying a huge skew towards the bottom third of the market. We got Rightmove saying there's lagging in the top end of the market. If you look at behaviours, we've got cost of living crisis, right? We've had people during the pandemic moving out of cities into larger country homes, okay, to get away from other people, right? We're now seeing a reversal of that trend, which is people going from those larger country homes maybe back into cities because that sort of panic of the COVID pandemic has passed and people are more willing to be back in cities. So we're seeing a reversal of that trend over the last few years. People going back into city centres, smaller units, and also potentially trading down from bigger houses because the cost of living is now squeezing incomes, both with interest rates with mortgages, but also with utilities and all that sort of stuff. Okay, people are now trading down to smaller homes. So are we seeing a reversal of people going to smaller, cheaper properties, which are going to give potentially a higher price per square foot because they're doing that using this hedonic regression model? And is that the reason between the difference in stats? Honest answer is I don't know. This is a hypothesis, right? This is a hypothesis, but it's an interesting hypothesis. If that's the case, what effect is this going to have over the next 6 months, the next 12 months? If people are going back into smaller properties, before we talk about that, there's a few things that I think are going to cause a further drop in house prices? And by the way, again, I talked about this last week. All markets are like a spring, right? They compress, and when you let go of them, they go back up, or you expand, and when you let go of them, they compress. Right now, I feel that we are in a compression, okay? We're seeing things come down, but that's going to be a short term. I'm short-term bearish in property. So short-term, I think those prices are going to continue coming down, but long-term, very bullish. So I want to talk very quickly about the arguments for property prices coming down versus the arguments for property prices going up. And in the short term, okay, the arguments for property prices going down, as we talked about previously, are interest rates going up, and it'll be interesting to see what happens with the next monetary policy committee. Interest rates going up, high inflation, which is causing interest rates to go up, cost of living crisis, again caused by inflation, squeezing people's affordability. If we look at, there's another graph on the amount of fixed rate deals with mortgages that are going to be expiring over the next year or two. You can see 2023, the year we're in now, has the biggest peak of fixed rate deals set to end in this year. So it's over, what's that, about 1.8 million in 2023. And then 2024, we're still at sort of, 1.6. So we're still having a lot of people coming off cheap debt this year and next year, right? We have persistent inflation at the moment, right? I'll get back to that. Persistent inflation at the moment. And if interest rates continue to go up, right, that's going to put additional burden on people. It's just maths, right? In those circumstances, things have to kind of continue. The biggest trigger, so we're in a fragile market at the moment, right? People's finances are stretched. For me, the biggest trigger that would cause a market crash is supply increasing. So at the moment, we'll talk about the arguments for long-term price growth in a second, but the property bulls generally talk about supply demand as the reason for property prices going up, and I agree with that. Short term, if we have an increase in supply, let's say a lot more people are moving, for example, they can't afford their big houses, right? And they're trying to downsize, and we see a big increase of supply come on as people try and downsize, right? Are we going to see that put further pressure on prices? If we look at the black line here is homes for sale per estate agency branch, okay? So you can see from beginning of 22 to now, that is steadily increasing. Now we're still below pre-pandemic levels, okay? So it's not like we're suddenly flushed with huge amounts of supply. We're still below pre-pandemic levels, but the trend is upwards for supply, okay? If the trend continues upwards for supply and interest rates continue to go up, it'll be interesting to see what happens in the next meeting, and people's affordability continue to be crunched, okay, that will lead to short-term drop in housing prices or continued drop in housing prices. It's just maths. I can't see how it won't. A lot of people talk about, well, in fact, let's just look at this. It's another interesting graph here. This is share of agreed sales with price reductions versus the average. You can see again, Jan, Feb, March, 40% of sales have got price reductions on, so we're still seeing prices reduced. This is property market changing is glacial, right? This is glacial. We're still seeing all the indicators for me showing, we're going to continue this negative downtrend. And then when we talk about inflation and cost of living, let's just look for a moment at some, certain world events that are out there. Things like last week, right? We've got things like OPEC announcing oil output cuts. Oil output cuts mean price of oil is going to go up. Price of oil going up increases inflation, all right? Now, that's a really simplistic way of looking at it, but we've got these external factors that could put additional stress on an already stretched housing market. I'm not saying it's suddenly going to lead to it breaking and everything imploding. I'm talking about probably a continued drop in house prices, which, by the way, I don't think is a bad thing. This is not a great graph to look at, but this is real, so inflation-adjusted wages. I want you to look at, well, it's both actually, it's nominal and real. I want you to look at the green and the sort of burgundy line, which are the inflation adjusted. Now, this central line here is zero. So anything below it means real-time wage constriction. You can see right now, right, because people talk about wages are still going up. Wages are going up in nominal terms, but in real terms, right, wages are actually negative right now, according to this data. I mean, this is October, December 22. I haven't seen Q1 because I couldn't find the graph. I ran out of time, to be honest, from ONS. I don't know if it's been published yet. Maybe there's been an uptick over the last few months, but we've had wage crunch as well. So short term, I would say prices are still going to come down, okay? Let's look at the long term, however, okay? Let's look at, when I say long term, I mean sort of 2024 onwards. Because interest rates will not carry on going up forever. Okay, they can't. And there's interesting discussions going on right now, or I'm seeing, sort of, I like to try and pick up on the threads and the trends early. One of the trends I'm starting to see is more people talk about a rapid drop in inflation at some point. When it will happen, we don't know. And when there will be a rapid drop in inflation, it could overshoot the target and lead to quite aggressive interest rate cuts at some point. Okay. Now, I want to try and explain this whole sort of combating inflation with interest rates, which is quite a crude tool. And, again, I'm not a macroeconomic, I'm not an economicist, right? I'm not into economics. I just try and boil it down as simply as possible. Okay, interest rates going up is forcing more people, not forcing, encouraging more people to save, rather than spend, which is hopefully going to bring down inflation. But there's lots of other factors that's causing that inflation. Things like Ukraine war. We've got banking crisis going on right now. How's that going to affect things if we see some more banks topple? Potentially could lead to credit crunch, by the way. But that's another argument for the property bears. Anyway. And there's lots of external factors going on that's affecting inflation. We see right there, one of those is potentially, OPEC cutting supply, oil price is going to go up, and that filters through the entire supply chain. Okay. With putting interest rates up as quickly as they're doing, it's almost like, I think about it like you're trying to steer an oil tanker from the back of it, right? From the back of the oil tanker, that you put your input in, you move your steering wheel, whatever an oil tanker has, right? And it starts to turn, very slowly turn. You can't really see what's going on at the front, so you can't see how far it's turned. And you're like, oh, we're not quite there yet, let's put some more in. But actually the turn moment you put in could already be enough. So it's kind of the same with interest rates. So if they go up too quickly and too aggressively, we could suddenly see, right, inflation at the end of this year, beginning of next year, fall very dramatically and overshoot the target, go sub 2%, at which case you're going to have to start slashing interest rates again. So more people are starting to talk about this. Are we going to overshoot in the next sort of 12, 18, 24 months? And then, of course, we've got the supply and demand equation. And without a doubt, there is a lack of long-term supply of housing in the UK. So that supply-demand argument is always there for long-term growth. I saw an article in the Sunday Times this week, which is talking about the amount of councils that are abandoning their local area plans in terms of hitting the targets for house building, because they're never going to hit them. So rather than have these targets and miss them, they're just getting rid of the targets, right? This is not a good thing. This is going to constrain supply. As well, because house builders are throttling back right now. I'm going to do a video on this, and we're going to look at the graph of what we need to be doing to hit long-term demand versus what we're actually doing, and we are at a fraction of where we need to be. So long-term, there is going to be this supply-demand issue. So we're also coming to it, going to be an election run-up next year. What are the government going to do? They're going to want to win votes, aren't they? Does everybody want to be dying with this sort of cost of living crisis, or are they going to, try and ease it somehow with some vote winning strategies? So we could see next year rapid drop in inflation, rapid drop in interest rates, the supply demand curve in the UK continuing, right? And that's going to see asset prices come up. So I believe, right, we're probably this is not a prediction. I'm not Mystic Meg. This is my thoughts. We're in for more drops this year. I would like it to be shallow and sustained, because I think that's a good thing for the market. More drops, and then next year we could see it go off again, or the year after, or whatever. Something that is pertinent, and I'm just going to put this up before I go over to see if there's any Q&A that we want to do. Sorry, just give me a sec as I get the right graph up. Is this one here? And again, it's the only graph I can find, by the way, that's inflation adjusted, and it is based on the nationwide house price index, which I know some people go, oh, it's rubbish because it's the smallest one and it's kind of doom mongering. Still, nobody is talking about inflation adjusted house prices, which is real house prices. This is the one we really need to care about, in my opinion. Okay, I think we're over 10% down from the peak with inflation adjusted house prices already from August to it's March, isn't it? August to March, we're 10% down. Fairly significant. It's because inflation is high, right? So this graph shows it, right? 10% down. We've got Q1 of 2023 now. We care about inflation adjusted. We care about real house prices, because if we're just looking at nominal house prices, it's vaguely irrelevant, because everything else is going up at the same rate. So we need to look at it in relation to our buying power. Now, why do I like this, right? As a property investor and as a property developer, we go through these cycles My personal view is the last 6 months and now the next 18 months are a period of accumulation, right? If you were buying, let's say in the 90s, kind of below the red line, right, you're going to do very well for the next 10, 15 years, 20 years, right? If we're buying kind of, 2010, which is when I started buying, building my portfolio, 2010 to 2013, right, we're going to do very well as the cycle goes back up again. So I view ourselves, if you're a long-term investor, not a developer, not a flipper, long-term investor, regardless of what happens, now's probably a time to start accumulating, because when things do reverse, that's going to carry the value or raise the value of your portfolio significantly for the next cycle. If you look at cycles of being, people say sort of, what do they say, sort of 15 to 20 year cycles. I've always viewed it, I've got to have 3 cycles in my investment career. I started when I left the Air Force at the age of 30, so sort of probably 3. Finished 1, now going into the second. I built my portfolio at the beginning of the first cycle, which was post-credit crunch, 2010 to 2013 was when I did most of my buying. That's gone up very nicely. I've now exited some of those into cash to buy more now for the next cycle, is my thought process. There we go. That is some analysis of where we are right now. Let's see if we've got any comments. So I just need to sneeze. Excuse me. Okay, if anybody's got any questions, either on the live or if they're watching this on the replay, just put them in the comments and I'll always come back and answer those for you. What are your thoughts on that piece of analysis between Nationwide and Halifax? Do we think we've got any legs in that analysis? Do we think it is people downsizing, going from larger to smaller properties, which is, sort of skewing? Oh, the other thing I didn't mention, by the way, was just the mortgage approvals. That probably is worth mentioning if anybody's still here at this stage. I'll just put this on. Mortgage approvals are still absolutely rock bottom right now. Okay, we've had a small uptick, right, in the last month. But if you look at this line, okay, just look at the blue line for a moment. That's the relevant one. Post mini budget, they fell off a cliff. Okay, this sort of dropped down, fell off a cliff. So we're seeing much fewer mortgage approvals going on. So smaller data sets. So both indices, both Nationwide and Halifax, are based on mortgage approvals rather than UK HPI, which is based on sale completions, right? So we're not seeing any cash in these things. With such a drop in mortgage approvals, we're seeing a much smaller data set. A much smaller data set will lead to more skews, okay, to more variance. Bigger the data set, better the data. Smaller the data set, bigger the variance. So that is another reason, okay, why we're probably seeing this difference right now. There we go. There's my theory. At the moment, we're seeing people downsizing due to reversal of pandemic behaviours and cost of living putting a strain. Now, by the way, I think this is a good thing, because I think what it means is it's not going to lead to this. When people talk about housing market crashes, I think a housing market crash means different things to different people. Some people might think a housing market crash is, a 20% drop in house prices over a 2-year period. That's not necessarily a housing market crash. That's a correction. A housing market crash is generally triggered by an event. It could be like a black swan event. Let's look at the credit crunch of 2008, which sees a very sharp and rapid fall in house prices. I actually don't think we're going to see that, for the reason being, when you look at this data, right, if people are struggling with affordability, with interest rates going up, inflation high, rather than it getting to a stage where everybody's getting repossessed, right, and there's, banks defaulting and all of that sort of stuff, it looks like people, because they've had better affordability checks, because they've got more liquid cash probably from all the cash that's been floating about for the last 4 years, and because there has been nominal wage increase as well, people probably have a bit more buffers. Rather than getting into horrible difficulty and getting repossessed, what they're doing is they're downsizing. This, to me, would probably create a shallower, maybe a longer and shallower drop and correction, which is a healthy thing, okay? Go and speak to any stocks and shares trader. Any stock and share that goes up really quickly generally crashes, right? The bubble bursts and it crashes. If it goes up, you need to have a shallow dip, consolidation, so it can build and then it can go up again. And I don't see it being any different in the housing market. So I see a longer and shallower dip in prices as a healthy thing for the market. rather than a crash where the whole thing explodes and we lose 30% in the next 6 months, right? I don't think that's going to happen. What I also don't want to happen, right, is all these policies to be reversed, interest rates to be slashed to zero and loads of money pumped into the system. So I think that could pump everything up to a point where it does catastrophically explode in the future. We want healthy growth. And if you are following, sort of professional property investing techniques, the honest reality is average house price growth is completely irrelevant anyway, because we add our value through lots of other techniques, which I'm about to record a video this week that goes through the full end-to-end process, right, of the different structures and techniques we can use. But I've never looked at house price increases as part of my investment process at all. It's all about adding value through various mechanisms, recycling cash out to leave as little cash in a property as possible, and then multiply cash flow to get a really high return on the capital, if there is any, left in the property. If it goes up in value over time, fantastic, brilliant. But the investment decision is not made on that in the slightest. So I think that's quite an important thing to state. Right, have we got any questions? I don't think we do. And we've been going. Right, I'll leave, 10, 15, 20 seconds if anybody wants to put any questions in on anything I've just said there today. Any disagreements? Anybody want to put together a different view? Again, if you're watching this on the replay, please just put it in the comments if you want to present an alternative view, or if you've got your own theories on why there's a divergence between the Halifax and the nationwide. Also, what's your thoughts on the market over the next 6 months? Are you investing right now? Are you buying right now? Are you developing right now? What are you up to? And how is the market right now affecting those decisions? I am firmly buying right now with the right deal in the right location with the right figures. Okay, we've got one going through conveyancing, and one with an offer on, hopefully will tie up this week. All larger mixed-use buildings. Good. I hope that's been useful. Key dates for the next updates. Let's just go over to that. We've got a couple of key dates coming up. Let's just zoom out there. 19th of April is the next UK HPI. That will be Feb 23 figures. So 19th of April, which is a week or so, just over a week away, we'll go and live again and talk about that. The next big one that I think is quite interesting to look at is the 11th of May, which is the next Monetary Policy Committee meeting. We'll put a spread bet on if we're going to go up with interest rates or if they're going to stay where they are. My gut feeling is they will go up again, and hopefully that'll be the last one, but we'll see. Let me know your thoughts on that. All right, team, been an absolute pleasure. If nobody's got any questions, I shall see you on the next live. But keep your eyes out for the next video. I'm going to be going through the 3-step AAA method property investment model that I use and have developed over the last 10 years. And I'll walk you through each of those steps, how I look at investing in the UK property market. I'll see you on that one.